Welcome back, everybody. And today we have a very, very special podcast. I invited Michelle AmRhein, who is probably one of the best estate and business lawyers I've ever worked with in my life. She and I have worked for years together, and I asked her if she would be so kind as to come in and talk to all of us about this story on the lifetime exemption being halved at the end of 2025 in the United States, and just kind of walk us through some, what does that mean to us as business owners when we're thinking about transitioning or, just continuing on with our companies. So, Michelle, gosh, thank you so much for taking the time to be here with us today.
Thank you, Elizabeth. I'm glad to be here. It's my pleasure, and glad I can kind of share some knowledge and kind of treat this as an educational session to let people know what's going on the lifetime exemption. So.
Yeah. So how about tell us just a little bit about you and your background and, just what you're doing right now.
Yeah. Okay, great. Well, I'm an attorney with Cohen Payton & Payne, and my practice area is primarily on estate planning and business succession. So I basically just means I work with families to try to understand what their goals are, what their concerns are when it comes to their beneficiaries, when it comes to their businesses, when it comes to their assets and their legacy and their values, and how do we transition that to the next generation or to the beneficiaries, and hopefully try to do that in a tax efficient way, working with their advisors like you and CPAs and others. So that's kind of my primary areas.
That's great. Well, thank you. And, I would like to just maximize our time today. So I'm just going to turn it over to you. I think that you have a couple of examples and just a kind of a discussion for us. So, let's get started.
Okay, perfect. Well, I thought maybe the best thing to do is also just kind of start with kind of letting people know and kind of revisiting kind of what the lifetime exemption is, how it works, where we are, kind of how we got here. I think that it kind of always helps kind of set the framework. So the lifetime exemption is really kind of, I think about it as the IRS has given us all a coupon about how much we can give away during our lifetime or upon our death to individuals other than really our spouses and charities, and how much we can give away before they start charging us tax on the gifts that we've made. And so we can make some of those gifts during our lifetime. We can make some of them upon our death. But at the end of the day, we have this amount that we can give away. And so that amount changes and has changed over time. The big changes that we want to talk about is in about 2017, the IRS, or there was legislation to increase the amount with the IRS to about double where it had been before. And then what we're looking at now, so this year, we're about $13.61 million per individual. So that means that each of us can give away about 13.6 million, I'm going to round, during our life or upon our death before we have to pay the estate tax or the gift tax. The estate tax and gift tax kind of parallel each other. So I kind of think about them as being a bucket. And that tax rate is 40%. So if I give over that amount, then essentially I'm paying a 40% tax rate. So right now at the 13.6 million, if I'm married, then basically my husband and I or my spouse and I can give away double that amount. What we're looking at is at the end of 2025, so starting January 1st of 2026, that amount will basically sunset and we will go back to the half amount. So there will be continued inflation. So, we'll have another year of inflation, but, at the end of 2025, we're going to be about where we are now, cut in half, which will be about, $6.8 to $7 million rough estimate based upon what inflation is. We don't exactly know the amount. And so where this is really becoming important is where we're really trying to remind clients is for clients who have especially closely held businesses or assets that may be illiquid, where it's become even harder to basically pay those estate tax bills. Then really what we're thinking about is how do we kind of leverage this exemption while it's higher and maybe think about accelerating some gifting and accelerating some transitions of businesses and illiquid assets to our beneficiaries, or to whether it's the next generation, before this amount sunsets. And it is an automatic sunset. And so it will sunset unless there's legislation to specifically increase it or leave it the same.
Great.
So I'm going to pause there. Questions?
Yeah. What a great. Yeah, that's a great background on that. And I know that some people are familiar with it, and other people, I'll run into and I'll say, have you, thought about this, or do you know about it? And many say that they really don't understand it and don't know about it. And it is significant. One, the tax it's a significant percentage. And in most businesses, and especially in businesses that are, don't have a lot of cash or lower margin, or, they just are real estate oriented or something like that, it really, upon death, if the heirs would have to pay that tax, it forces the sale of the business. The business they have to sell in order to pay the taxes that are due to the government.
Exactly. Yeah. And so one of the things that we like to kind of think about, and one of the things we're talking to clients and I'm talking to clients about, is like, since we kind of have this horizon hanging out there, and because the implication and the impact can be really significant, it really becomes a good time to start revisiting and continue to visit. Does it make sense to start basically accelerating and gifting some of those assets away again while we are alive, and while that exemption is available to us? So one of the things that I get questions on is like, well, if I give away amount this year, and I use all of my exemption, and then I pass away and the exemption's less, won't the IRS then just send still a bill? And the answer is no. As long as I gave away an amount that I was allowed to give away, even if that amount is less when I die, but I've utilized that higher amount, I don't get to have there's not what we refer to as a clawback. So that doesn't get to bring assets back. So I thought maybe it might be good just to walk through a very high level example, because sometimes like hearing it kind of in an example with like a business or numbers kind of helps. So if that works well, then that's what we'll do. So
yeah, let's do that. Thank you.
Yeah. So I like to think about this. So we're going to keep it simple. I always like to use simple examples. It helps make the point. I understand that every scenario is a little more complicated, and that's okay. But let's say that we have a business or an illiquid asset or properties, whatever that is. And let's say the value this year is roughly $25 million. So we're going to say that's a husband and wife situation. So we have two exemptions that we get to use. So essentially I have $25 million of value, and I am willing and able, and it makes sense that during the time of 2024 and 2025, prior to the sunset, which is again at the end of 2025, I am able to give it, and I decide to give it away. So we give this asset away. And basically, because when we gave it away, we each had $13.6 million this year, more next year, then essentially we had sufficient exemption to use it, right? I have that coupon for $13.6 million. So I turn in my coupon, my spouse turns in their coupon. The IRS says, okay, $25 million. You've got coupons that's worth, basically $27 million. No problem. You get to file your estate tax or your gift tax return. Let us know that you did this. Let us know your exemption, but no tax bill. So then we're kind of off. And then say 2026 comes, the exemption amount has gone down. So we're now back to each of us having half that amount. And something tragic happens and we both pass away. Well, at that point, that $25 million asset is not included in my estate. We've passed it on. We have, maybe we have no exemption left because the exemption has gone down to, I'm going to use $6.8 million per individual. And so we've used all of our exemption. We have no more exemption left, but we've gotten that asset out of our estate. And like I said, there's no clawback. So the IRS doesn't get to say, oh, you used more exemption than you had when you passed away. that's not how it works. So we've gotten it out. We have no estate tax.
Yeah. And so in that example, your heirs would still have to pay the tax on your home or any other assets that you had over and above that business. But the big chunk is out. And
That's right.
That's significant. Yeah. So there's still tax too, but nowhere near potentially what it would have been.
Exactly. And you're right that typically you'll have other assets, other investments or retirement assets in the home. And you're right, those would be subject to tax. But you've gotten the large value and oftentimes the more illiquid asset out of the estate. Right. And so if I kind of walk through that same example, I have that same $25 million asset and I didn't gift it. And then we get to 2026 and the exemption, has gone down for each of us. And then we're in that same tragic accident. And so now our estate owns, in addition to those assets that we were just kind of commenting on, those other assets, it owns this $25 million asset, right? My exemption, if we take basically between the two of us, we're going to, again, use two exemptions, assuming we have both of us passed away, then essentially we're going to have about $14 million of exemption, right? We have 6.8. There'll be a little more inflation for 2025. So making the numbers easy, we're going to have about $14 million of exemption. That means I take my $25 million asset plus all these other things, but we're going to leave those out there because we've been paying tax on them anyway. We have our $14 million of exemption. So I now have $11 million of value, right, that I'm now paying a 40% tax rate on. So essentially I have about $4.5 million of taxes that's going to be owed that my beneficiaries are going to have to come up with those funds to pay those taxes. And so that's really kind of the things that we're thinking about and we're talking about when we have this horizon now that's coming and kind of creeping ever closer to us from the standpoint of timing.
Yeah. And so just, imagine, I think, and this is what I do, I imagine that I'm the beneficiary of this beautiful business that's worth $25 million. And I'm so excited about taking it over. And my parents pass away, which is hard enough. And right. Then I'm faced with a $4.5 million tax bill that I really wasn't expecting with a business that's relatively illiquid, if not completely. And also, if I have siblings, we are trying to figure this out, which is a very challenging problem, typically in a very challenging time because they're taking over the business and doing everything, exactly. Plus the loss of the parent there. So, when you think about it, it's just something that I thought would be great for our listeners to start to think about and understand just what's coming and what the implications are in their lives, how this might affect them.
I agree. And what I'm telling individuals is, so we kind of talked about really the basic approach, and like everything, there can be added, layers of complexities from that standpoint, meaning like there's, we don't have to use both spouses exemption. Maybe we decide to use one spouse exemption. And when the other spouse passes away, they will still keep their exemption. So, and sometimes when we're using entities, there may be opportunities for what we call valuation discounts, where we get to value the interest in that business less than the underlying asset. The point of all of that is just that, there can at times to do the maximum planning, there are steps that may need to be taken. There may be entities that need to be formed. Buy, sell, and operating agreements need to be maybe perhaps reviewed and revised. Sometimes we want to do gifting between spouses and we want some time to pass between that gifting between spouses. And so I think what my big point for takeaway too is like, want people to have it on their mind, but also have some time to really think through the process. And so they're not at the last minute feeling like they're not sure about something. And is this the right decision? But they've had time to really process it, to really walk through the steps and to really make sure that they're comfortable with it and their family's comfortable with it. And everybody kind of knows how it's going to work and that they've done kind of the maximum planning that they can, rather than a crunch time decision that they aren't 100% sure about, or they have to kind of really make some decisions in a time frame that maybe is not as comfortable for them.
Yeah. And, you and I have done a lot of work together. And so, what comes to mind for me is, what are some of the owner's objections? And it's like, oh, well, if I, give it all up now, then I'm going to lose control, or I'm going to lose the ability to have an income stream that I really need, or there are a variety of things that to think about there. And, in that topic, in that world, there's so many things that can be done to get the asset value out while also maintaining control, like voting and non-voting type shares can be built, or and agreements can be put together on how much a person makes to operate and run that company and how that works. So a lot of different ways that you can actually get it out of your estate and transfer it so that your next generation doesn't get put in that position, but you still are able to operate and maintain the control until you're ready to let it go. That's all a part of just the strategy.
Right. And, you're right. You and I've worked together. And so, we understand that there, in addition to just like, this is a tax planning opportunity, it is really important for families to have that emotional comfort and understanding about what what their goals are together, what they're trying to accomplish. And like you said, we don't want them to be in a situation where you're trading one sleepless night over one thing for another sleepless night over another concern. So the idea there is to really kind of work with them and kind of understand, what are their goals and what are they comfortable doing and how do we get them as close as they can. We're not trying to exchange one worry for another worry. And that, and I know that, and we work together on those type of things. So it makes, that is definitely one of the goals as well.
Absolutely. Yeah. We like sleep full nights. Right?
Exactly.
Sleep full nights where you go, wow, I'm just sleeping. I got the tax thing figured out. I got the kids are good. We've got it all done and I don't have to worry. And I'm okay as well. And, the other thing I think that is important is just the keeping in mind what appreciation happens too, because there's this opportunity that's here. And then, you may say, gosh, you know what? My business isn't worth that. And I don't have a tax issue and it's okay, for me not to worry about that. But, if your business is over what would be the halved rate, if it's over that, even in the middle there, it may be okay to go ahead and transition it because you never know what the value is going to be in the future. And the appreciation, I think people sometimes forget to put that into their thinking.
You're absolutely right. That oftentimes we're looking at, like you said, if you're not in the taxable estate in the where we are now, but you're kind of in that lower amount and right, you don't know what the appreciation will be. If if it's only 12 million now and I give it out, or 10 million and I give it out, and I live another 20 years and that appreciation is now higher than the exemption is, then we are still in that same kind of scenario. So you're right. It's not just, from the standpoint of double the exemption, but it's also if you're exceeding the amount when the exemption goes in the half amount. So you're right. There's opportunities to get that future appreciation out as well, and make sure you're kind of planning for the long term.
Absolutely. And don't we all, as a business owner, don't you hope that your business is going to grow and hope? I mean, that's what you're working with, right? You have a strategy for growth and development and enhancement of value. All of those things are fun and it's part of the business, kind of the business game, it's a part of winning.
Yes.
Yeah. And then the other thing that, all of this conversation, nobody knows what the inflation rate's going to be or what the taxes are going to do or what the government's going to vote in or not in the future. And so I know that there's a lot of work in thinking through this. And sometimes in my conversations, it almost feels like gambling in a way. You're just going to do your very, very best to make the very best decisions based on the rules that are in place today, and kind of roll those dice. And if it's not the right thing for you to do it, then you're just not going to do it, because there are some people that won't take advantage of this exemption, and others that will say, gosh, absolutely, I wouldn't miss it for anything.
Right. And I think that's a lot of that conversation. Like you're saying, it's like understanding what your choices are. And I think that's a lot of it, is just, making sure you're making the educated decision and not letting it be 2026, 2027 and saying, oh, I didn't realize that I had that opportunity. And so a lot of it is about that educated decision about it, and looking at ways to do it in a creative way, and options that are out there that, like you said, that can help alleviate some of those other concerns that might be there. But we don't know. And, we do kind of, in a way, joke that, we know exactly the date and moment that, someone's going to pass away, then plans can be perfect or closer to perfect, but we don't, and life throws us a lot of unknowns and things that we can't anticipate. So, you're right. You do your best, and you try to take advantage of when it makes sense to do it for your family and for your business.
Absolutely. Absolutely. Well, gosh, this has been terrific. And I just, I appreciate you so much, and appreciate you being here. And one of my favorite things to do at the end of the podcast is to ask, just what one piece of advice or what one recommendation would you leave with our listeners and our audience when they are starting to look at this and decide what they're going to do?
Yeah, that's a really good question. I think from my standpoint, when I'm working with families, I think that communication and having an honest conversation with yourself, with your significant other, with your spouse, and and sometimes with the kids, whoever's involved, about really what are the goals and what do you want to accomplish? Because I think if everybody kind of understands that, it can make these decisions and these transitions easier than essentially making a decision in a vacuum. So I think communication early is important from that standpoint. And maybe my second piece is timing, because these things do take time. And so it's important to think about them sooner than later.
So basically, don't wait until December 1st of 2025 to start thinking about it, and reach out to your lawyer, your estate lawyer, or your business lawyer who are buried, because everybody else did that too.
Yes.
Yeah.
And work with your advisors like you to kind of make sure the family's all kind of talking about it. So
right. Well, that's great. Well, Michelle, thanks again for being here and for sharing your knowledge with us and your expertise. Again, appreciate you. And thank you.
Well, thank you for having me. It's been my pleasure. And hopefully this gives everybody a little kernel of information to move forward that can have big impacts.
Perfect.
All right. Thank you.